Most people think they understand the cost of owning a home. They look at the mortgage payment and assume that everything else is minor. That is the first mistake. The real cost of homeownership lives in the expenses nobody likes to talk about. Because these costs do not build wealth. They only stop the house from falling apart. When you own a home, things break. Not sometimes. Constantly. Roofs wear out. Heating and cooling systems fail. Water heaters die. Pipes burst. Foundations crack. These are not upgrades. They are not investments. They are emergency expenses that show up whether you are ready or not. When you spend money fixing these problems, that money is gone forever. You're not adding value. You're just keeping the house usable. This is where the myth starts to collapse. People love to say that rent is throwing money away, but repairs do the same thing. Replacing a furnace does not make you richer. Fixing a leak does not increase your net worth. It simply prevents damage from getting worse. Financially, this money behaves exactly like rent. You pay it and you never see it again. On average, maintenance and repairs cost about 1% of a home's value every year. On a moderately priced home, that can mean hundreds of dollars per month. And this is not optional spending. You cannot skip it without risking serious damage. Unlike rent, these costs are unpredictable, uneven, and emotionally stressful. The problem is not that people underestimate these expenses. The problem is that they pretend they do not exist. When you ignore maintenance costs, homeownership looks cheaper than it really is. Once you include them honestly, the story changes. Owning a home does not magically turn monthly expenses into wealth. A large portion of that money simply disappears, just like rent, only with more responsibility attached. And once you understand that maintenance money quietly disappears, there is a much bigger cost most people never even see. This is the cost that actually does the most damage to your long-term wealth. It is called opportunity cost, and it is the most misunderstood part of buying a home. Opportunity cost is simple. Every dollar you put into a house is a dollar you cannot put somewhere else. When you make a large down payment, that money does not vanish, but it becomes trapped. It is locked inside a property instead of working for you in other investments. Historically, broad stock market investments have grown much faster than home values over long periods of time. Stocks have averaged strong annual growth, while homes usually increase in value at a much slower pace. That gap matters. When you tie a large amount of cash into a house, you're choosing a lower growth asset over a higher growth one. The difference between those returns is not theoretical. It is real money you are giving up every single year. This is not a small detail. Over time, it compounds into a massive number. The reason most people ignore this cost is because it feels invisible. You never write a check for opportunity cost. There is no bill in the mail, but make no mistake, it is still a cost. And in many cases, it is larger than maintenance, taxes, or insurance combined. By ignoring opportunity cost, buyers often convince themselves that buying is automatically better than renting. They focus only on what they pay, not on what they are giving up. But wealth is not just about what you spend. It is about where your money has the chance to grow. When you understand opportunity cost, the buy versus rent decision stops being emotional. It becomes mathematical. And once you see the math clearly, it explains why owning a home does not always mean building wealth, especially in high-price, high-rate environments like the one we are in now. Once opportunity cost is clear, the next layer of the problem becomes impossible to ignore. Even after you commit your savings to a down payment, the structure of a mortgage itself works against you in the early years. This is where the idea that buying a home is forced savings begins to break down. At current mortgage rates, interest is not a small detail. It is the dominant expense. In the first years of a long-term loan, most of your monthly payment does not go toward ownership. It goes to the bank. This is how amortization works. The loan is designed so that interest is paid first, and principal is paid slowly over time. On a typical purchase with a modest down payment, the numbers are sobering. Thousands of dollars each month leave your account, but only a small fraction actually builds equity. The rest disappears as interest. That money does not increase your net worth. It does not become accessible savings. It is simply the cost of borrowing. This reality directly challenges the idea that buying a home automatically forces you to save. Yes, you are making payments, but most of those payments are not building wealth early on. They are just servicing debt. Meanwhile, a renter who pays less each month can invest the difference consistently and build liquid assets that grow and remain accessible. Liquidity matters. Equity locked in a home cannot be easily used without selling or borrowing more money. Investments, on the other hand, can be adjusted, accessed, or reallocated as life changes. That flexibility has real financial value. When you combine mortgage interest with opportunity cost, the picture becomes clearer. You are not just paying to live in a home. You are paying interest on borrowed money, while your own cash earns lower returns elsewhere. This is why early homeownership often feels expensive without feeling rewarding. The equity grows slowly, the interest costs stay high, and the financial progress is far less dramatic than most buyers expect. When you combine maintenance costs, opportunity cost, and mortgage interest, the picture finally becomes clear. At this point, the rent versus buy decision stops being confusing. This is where the 7% rule comes in. It is not a trick, and it is not a prediction. It is simply a practical way to measure the real cost of owning a home. Every year, homeowners face several unavoidable expenses. Property taxes typically consume about 1% of the home's value. Maintenance and repairs add another 1% on average. Opportunity cost and mortgage interest together account for roughly 5%. When you add these numbers honestly, the total comes out to approximately 7% of the home's value every year. Instead of debating opinions, the rule turns the decision into a simple calculation. Take the purchase price of the home, multiply it by 7%, then divide that number by 12. The result is the monthly cost of ownership that you will never recover. This money does not build equity. It does not come back when you sell. Financially, it behaves the same way rent does. This number becomes your break-even rent. If you can rent a comparable home for less than this amount, renting is financially superior. If owning costs less than similar rent, buying may make sense. No emotional arguments are needed. No pressure from family or friends. Just the strength of the 7% rule is that it adapts to the current market. When prices rise or interest rates increase, the rule reflects that reality immediately. It prevents you from comparing today's market to periods when mortgage rates were far lower. Most importantly, this framework puts control back in your hands. You can run this calculation in seconds, using real numbers from your local market. Once you do, it becomes clear why renting can be the smarter choice in many situations. The decision is no longer emotional. It is simply about which option costs you less money every month right now. Once you apply the 7% rule to real numbers, the reality of the current market becomes hard to ignore. This is why, in the 2026 housing market, renting is financially better for most people in most areas of the United States. Mortgage rates are expected to stay in the low 6% range throughout 2026. That means borrowing money remains expensive. At the same time, home prices are not growing fast enough to offset those costs. Forecasts suggest home values may rise only about 1% to 1.2% per year. That is slow appreciation, especially compared to the high interest buyers are paying on new mortgages. Now look at rents. Over the past 2 years, rents have declined year over year in many markets. Looking ahead, rents are expected to increase only modestly, roughly in line with inflation, at about 2% to 3%. That means renters are seeing improving affordability, while buyers are locking themselves into high fixed interest costs for decades. This creates a clear imbalance. When you buy in this environment, you commit to expensive debt at today's rates. When you rent, you keep flexibility. You can adjust as prices change. More importantly, you can invest the difference between renting and owning instead of sending it to a bank as interest. Over time, that difference compounds. In many realistic scenarios, renters who consistently invest their savings can end up significantly wealthier than homeowners in similar properties. Over a 10-year period, that gap can reach around $120,000. That is not a small number. That is a meaningful change in financial trajectory. This is why the math points in one direction right now. High rates, slow home price growth, stabilizing rents. In that combination, renting is not a fallback option. It is a rational financial strategy, not forever, but for this market, at this moment, with today's numbers. None of this means buying a home is always a mistake. The point of this entire breakdown is not to push everyone toward renting. It is to replace assumptions with understanding. Buying can absolutely make sense, but only under the right conditions. And those conditions are far more specific than most people are led to believe. Time is the first requirement. Homeownership only works financially if you plan to stay in one place for a long time, usually 10 years or more. Shorter timelines make transaction costs and interest overwhelming. The second factor is the size of the down payment. Large down payments in the range of 30% to 40% reduce mortgage interest and lower opportunity cost. Without that, ownership remains expensive. Interest rates are the third key variable. When mortgage rates fall to around 4% or lower, the math improves dramatically. Equity grows faster, interest consumes less of the payment, and buying becomes more competitive with renting. In high-rate environments, the opposite is true. Then there are the non-financial reasons: stability, control over your space, the emotional comfort of ownership. These benefits are real, and for some people, they are worth paying for. But they are not free. Choosing them means accepting higher costs, lower flexibility, and concentrated risk. This leads to the most important lesson. Renting is not throwing money away. Buying is not automatically building wealth. Both options involve money that disappears every month. The smart decision is not based on pride, pressure, or outdated advice. It is based on math, timing, and personal priorities. Markets change, rates change, life changes. That is why the right choice today may not be the right choice tomorrow. Run the numbers for your situation, in your market, with current data. Ignore the noise. The goal is not to own a house. The goal is to build a life and a financial future that actually works for you.